An important piece of tax legislation was passed and signed into law on July 4th. It keeps a lot of things the same and changes some others. Mike Cease and I will dig into how this might help you right after this. Hello, welcome back to Wealth Wednesday. I'm Neal Watson, a certified financial planner, and joining me today from his Vienna office is my friend and fellow CFP pro, Mike Cease. Mike, great to have you on.
Thanks, Neal. It's always great to be here.
The new law, the one big beautiful bill, has a lot of moving parts. Today, we're going to break down what stayed the same, what changed, and how it could impact your tax strategy for 2025 and beyond. Mike, let's start with what hasn't changed. The ordinary income tax brackets we've all gotten used to under the Tax Cuts and Jobs Act from 2017, those are sticking around, aren't they?
That's right, Neal. The 10, 12, 22, 24, 35, and 37% tax brackets are now permanent. That means no big surprises when it comes to your marginal rates, and even better, those rates will continue to adjust for inflation each year.
And I saw that in 2026, the lower brackets, the 10 and 12%, get an extra bump for inflation indexing, which should provide a little more breathing room for many taxpayers.
Exactly. So the bottom line, your tax brackets are now stable, and if anything, slightly more favorable over time.
Yeah, and this has been a big relief for us as we're trying to plan about things going forward. Now, let's talk about something that did change, the standard deduction. Mike, what's the new story there?
So for 2025, the standard deduction is now higher, and that's now permanent. So here are the numbers. For a single filer, that number is $15,750, and it's $31,500 for married couples filing jointly. And so even better, for those 65 or older, you still get the additional amount that's always been around for years, but now that's also, there's a new enhanced senior deduction.
Yeah, this is big, and this actually happened instead of the no taxes on Social Security promise we heard about during the campaign season. So how much more are we talking about here?
It can be up to $6,000 per person, and that's on top of the regular standard deduction. It does phase out as your income goes higher. So those amounts are for $150,000 for joint filers, and it's completely gone at $250,000. But for most or many retirees, it can still have a huge impact.
Yeah, that's a lot of extra room to reduce taxable income, especially for those retirees. Read somewhere where it's going to benefit about 88% of those people over 65. It creates some interesting planning opportunities as well that you should probably be talking to a planner about. Consider maybe doing more Roth conversions at a lower tax cost because of this. Now, let's tackle one of the big things that was a hot issue during the campaign season, and that is what we call the SALT deduction, and that's state and local income taxes. Under the old rules, the cap was $10,000. That changes in 2025, doesn't it?
It does, Neil. In 2025, the SALT can jump up to $40,000 for most filers, and it's $20,000 if you're married filing separately. That's a major change, especially for people in high tax states. And I want to add, I'm glad you explained what SALT was, because most people don't even know what SALT means.
Yeah, and it's not unlimited, though, that deduction, is it?
No, it's not. There's an income phase out that starts at $500,000 for joint filers, and it's $250,000 if you're filing separately. Even if you phase out, you still get the fallback amount of a $10,000 deduction. But for many households, this increase is going to make a huge difference.
So let's focus on what is not in this bill going forward. In 2026, there was a lot of chatter about what happened, what is in the law, and what's not here.
Neil, that's a great question. I mean, here's the reality. There's no major new provisions for 2026. There's no broad expansion of the child tax credit, but there are some new deductions that will start in 2026. For example, number one, the charitable giving for non-itemizers. You'll be able to deduct up to $1,000 if you're single, or $2,000 if married filing jointly for cash gifts to qualified charities, even if you don't itemize. So that's a big one. Number two, there's card loan interest. Starting in 2025, you can deduct up to $10,000 of interest on new car purchases. However, there's a catch. The car has to be assembled in the U.S.
Yeah, it's an interesting one. A little incentive for those American-made cars, which was something that was campaigned on very heavily. Now, there are other parts of the bill like provisions for overtime and tips. And if those situations apply to you, we're going to be happy to talk to you directly about those, but it's kind of a narrow focus on that. But if you have questions, let us know. Mike, what's your advice for people watching this?
Don't assume your tax picture will stay the same. These changes, bigger standard deductions, possible SALT relief, and those senior enhancements can really impact your planning. This is a perfect time to revisit projections, charitable giving strategies, and income timing with a professional.
Yeah, it seems like there's always two constants with tax laws. There's always changes on the horizon, and they always seem to make it more complicated. But there are some opportunities here, and it's a good time to dig into your financial plan. Mike, thanks for being with me today.
Neal, always happy to help.
And thanks to all of you for watching Wealth Wednesday. If you found this helpful, please give it a like and also subscribe to our channel. Be sure to share this video with someone you know who might find this useful. Thanks for watching. Have a great week.